Now, a very good morning. We've got a very interesting week this week. We've got the Federal Reserve meeting, the Bank of England, the ECB, and the Swiss National Bank all meeting in the same week. So it's going to be an important one. And the big sort of picture to be aware of is that markets are they're really looking at this kind of response. If you look at the bond market, we can see that bonds have seen some strong bids in the US, the German Bund, the UK gilts, all finding buyers in expectations that, these central banks will begin cutting interest rates quite early in 2024. And then for the US, there's expectations of 4 interest rate cuts. There's expectations of maybe a first quarter ECB interest rate cut. And that's what's been driving this bid into the bond market. Now, it's most likely that central bankers around the world, they don't want markets running with that narrative because they don't want to signal easier monetary conditions. Because if they signal easier monetary conditions now, that's going to inject a whole lot of capital into the system, which is inflationary, and they're trying to quash inflationary forces. So even if central bankers are pleased that they are winning the inflation battle, and we've seen inflation falling in Europe, falling in the US, really big drop in inflation for Switzerland's 1.4%, the headline, well within the SNB's target. They're not going to want to communicate victory, job done, inflation's behind us, because that in itself could be inflationary, and the little dip we've got could then suddenly start to build. Like we saw in the 70s, a stagflationary environment where we appeared to win the battle, people took the foot off the gas, and inflation grew and was even worse than before. So that's what central bankers don't want to do. So they're very likely this week, this is the opening sort of framework to be understanding the market through, is that central banks are very likely to push back against that narrative, and they can do so in all sorts of different ways. So let's keep that in mind as we start to look at what's ahead this week. Monday, very little on the data front. We got RBA's Bullock speech. Remember that the RBA have said that they're really data dependent. So in terms of Bullock's speech, if she sort of starts indicating, yes, we need to hike interest rates, then look for that to lift the Australian dollar, because we're quite neutral with the Australian dollar at the moment, with the RBA saying that they're data dependent, and any strong rhetoric from RBA's Bullock is likely to lift the Australian dollar. Japanese data is being pushed and pulled really around the Bank of Japan narrative about Governor Ueda, whether he meant to signal next week a timing of interest rate cuts, etc., etc. What we've seen out this morning is that the Bank of Japan has said that they see little need to end negative interest rates in December. They're meeting next week, and they intend to come to a decision based on the data up to the last minute. So they're just pushing back against, Ueda last week. He was sort of sounding almost like, do I raise interest rates to zero? Do we do it to 0.10%? How fast do we go? Almost like he was really thinking about raising interest rates, and that's what we saw, that yen strength last week. So the PPI data unlikely to have much of an impact on that. It's all to do with communication and timing of the Bank of Japan exiting negative interest rates. First interesting data point for the week is the UK data. Now, markets are kind of, the Bank of England's meeting on Thursday. Is this going to change interest rate expectations for Thursday? No. But will it potentially change interest rate expectations for 2024? Yes. At the moment, markets see the Bank of England staying on hold. It's expected to be a 6-3 vote in favour of holding, with 3 hawkish dissenters. And the first interest rate cut is sort of signalled around this June region. So that's kind of the assumption. So what we're looking for here is, if this employment data is very, very weak, that will bring forward interest rate cut expectations. Now, we have had the Office for National Statistics, and there was some controversy over the way this has been calculated, and some analysts have had a lot less reliability on this data. Nevertheless, in terms of a short-term scalpel opportunity, it'll be fine for an opportunity. So if this comes in much lower than markets expecting, if we start to see these average earnings coming in below markets minimum expectations, below 7.4 for below 7.3, if we see the unemployment rate rising significantly, 4.3 or higher, if we see the climate count change and the UK employment change, say we say this coming in as a sea of red with a below minimum expectations on the average earnings, then I would expect that to weaken the pound around the margins. I would expect that to weaken the pound. So just keep that in mind. If it's very strong data and above market maximum expectations on a really strong jobs print, I also expect that to lift the pound. It would only be a short-term trading opportunity, maybe intraday, maybe 20, 30 points. Nevertheless, it would be there. There was a sensitivity to labour data. We know labour data is inflationary or deflationary. Strong labour data, inflationary. Weak labour data, deflationary. And that's another point that all the central banks, they want to see a weakening in the labour market before they start having confidence that they can begin signalling interest rate cuts. As long as the labour market remains strong, then in their minds, there's still this big inflationary pressure, quite rightly, in the financial system. So labour data is important for all the central banks, and there'll be a short-term scalpel opportunity, despite the questions there's been about the reliability of the latest calculations from the Office for National Statistics here in the UK. Then we got a really interesting one, US CPI inflation. Very clear here. High inflation should support the dollar. Weak inflation should weaken the dollar. So if we see core coming in for the month on month below 0.1, headline year on year below 3.9, headline below 3, then look for dollar weakness. So you could look for gold upside. On the other side, if we see it very strong, 0.4 for the month on month, 4.1% for the core year on year data, and 3.2% for the headline, then look for dollar strength, and maybe something like euro US dollar selling would make sense in that environment. Again, short-term scalpel opportunity. We got the Fed meeting on the Wednesday, so short-term that sets the mood for the Fed, but then we'll have a reset and be looking at a new set of dynamics for the Fed meeting. We've got some Japanese Tankan data. Now that's been showing some strength in Japan with the, continued improvement basically amongst Japan's large manufacturers. So markets will be looking at, is that carrying on? And of course that, if it is carrying on, we saw, we've seen 2 out of the last 3 months moving higher. If we see another jump higher in manufacturing out of Japan, that should support the yen. Obviously, it's going to be Japanese monetary policy that's going to be driving the yen, but nevertheless, this can put pressure on monetary policy as well. So if it comes in very, very strong, remember the Bank of Japan, what they're looking at is they want to see wages rising in Japan. And if you start to see, earnings, manufacturing sector doing better, that's all going to put pressure on earnings needing to rise and a little bit of inflationary pressure. All of that should support the yen and the monetary policy. So just, is it tradable? Probably not. But does it set the sort of mood? Yes. So keep that in mind. On Wednesday, I'm not particularly looking at the UK goods GDP industrial production. Obviously, if this comes in much lower than market's expecting, then I would expect that to weaken the pound. And again, if much higher than market's expecting to strengthen the pound, I'd use the minimum maximum expectations. But it'd have to be an out of consensus print really to find much interest there. We've got some PPI data out for the US. Expect a similar reaction to the CPI data. If PPI data comes in very strong, expect it to support dollar. Very weak, expect it to weaken the dollar. But of course, we then got the Fed meeting in just a few hours, so it would be only the smallest of opportunities for intraday traders. We then have the big decision, arguably the biggest decision of the week, the Federal Reserve interest rate decision. Now, at the last dot plot, this is, what the Fed was saying. They expected one more rate hike this year, and they're expecting the median rate for 2024 to be at 5.1%. That was the last dot plot. We do get a dot plot this year, this month rather. So look for the dot plot again. And in terms of expectations, this is what they are. 100% chance of a hold. That's what markets are seeing. And they're seeing actually up to 4 interest rate cuts approximately next year. So that's very, very dovish pricing. And all that dovish pricing has been strongly weakening the dollar. All through November, we've seen the dollar weak. Oh, the Fed might be cutting interest rates all once, twice, 3 times, 4 times. That's very optimistic. And we've been here many times before where short-term interest rate markets they've been sort of signaling that there's lots of rate cuts to come, and then the Fed have just pushed back against it. I'm expecting exactly the same dynamic on Wednesday. So the best kind of opportunity is going to come from a situation where the Fed, don't signal interest rate cuts next year, for instance. So they keep interest rate cut expectations, and we're not expecting any cuts next year. Expect immediate dollar strength. And you expect gold downside. And you expect euro US dollar selling, pound US dollar selling, something like that. And look at the press conference afterwards to see how Powell communicates. The Fed's not going to want to say job done because it's going to fuel inflationary pressures. So they're almost certainly going to be pushing back against that recent rhetoric. Now, obviously, if they don't, that will be a huge shock. So if they start saying, yeah, well, actually, we could see a rate cut, March, May next year, that's reasonable. And we think that the interest rate cuts are behind us. We're signaling an official end to interest rate hikes, rather. And now we're looking at interest rate cuts. We're confident we've avoided a recession, and we're confident that we're going to win the inflationary battle. If they said that, which they're very unlikely to, then look for immediate dollar weakness, Aussie US dollar upside, New Zealand US dollar upside, but the instrument of choice will be gold upside. So very important one for the US on Wednesday. Thursday, RBA using a neutral data dependent spot. So strong employment data should lift the Aussie. Weak employment data should weaken the Aussie. So again, if you see employment above 30,000, if the majority of that's full-time, unemployment rate, say that's low again, below 3.6% ideally, then look for Australian dollar upside, because there will be inflationary pressures that the RBA is likely to have to deal with. Again, if it's a big miss in the data, look for Aussie dollar downside, and I'd look to trade that against the New Zealand dollar. So if you suddenly see the employment below minus 30,000, unemployment rate above 3.9%, participation rate falling as well, ideally, then you're looking at Australian dollar weakness, and I would trade it against the New Zealand dollar. It's your go-to kind of RBA, RBNZ interest rate, monetary policy divergent pair. Then we've got the SMB interest rates. Now, Switzerland have been doing, if you look at Swiss inflation, look, it's 1.4%. So, it's well within the Swiss's inflation target. The one area that's being sort of bandied around about concerns for the SMB is the rent prices. So if rent is still a risk for the SMB, then you could see a surprise interest rate hike. But even if we did see a surprise interest rate hike, I wouldn't expect that to support the Swiss franc for very long. So the best opportunity I want to see a dovish SMB. They sort of push back against recent strength we've seen in the Swiss franc. So the best opportunity for here, if the SMB either hold or they cut or they start to signal cuts ahead, anything like that. They sort of say, we're confident we're going to hit the inflation target, and they allow some of that recent Swiss franc strength to offset that. Now, they've allowed the Swiss franc to strengthen because it helps them fight their domestic inflation by allowing a strong Swiss franc with their major trade partner Europe suffering high inflation. It's helped the SMB to talk up, the strength of the Swiss franc. If they start unwinding that rhetoric, I would look for some, significant Swiss franc downside, and I'd probably try and trade it against the yen, with the Bank of Japan expected at some point to exit negative interest rates. Swiss franc yen downside could be a good go-to currency pair on a dovish SMB interest rate. If they're more hawkish and they hike by 25 basis points, look, there might be a sudden short upside in the Swiss franc. So I'd scalp it for a quick intraday opportunity, but I wouldn't have confidence in it because, look at the Swiss inflation. It is within target. So that would be mainly like a positioning, posturing, rather than actually a policy that they're expecting to increase interest rates moving forward. That would be the last one that I would expect from the SNB. And if you look at short-term interest rate markets, they are saying, 26% chance of a cut, right? And they're seeing the first interest rate coming as soon as March, somewhere between March and June next year. So, that's where we're at with the Swiss National Bank. Then once we got that through Swiss decision, we got the Bank of England interest rate decision. Now, the Bank of England's Bailey has constantly been wanting to talk up. We might have to hike more, but he's recently been stressing concerns about slowing growth. He's sort of saying, last commentary that I saw from Bank of England's Bailey last week was he was saying the full effect of higher rates haven't been felt in the UK yet, and rates will likely need to remain around the current level. So he wasn't saying, we might have to do more. He's saying, okay, we might have to stay higher. And my general perspective is I'm expecting these central banks to say, higher for longer. So I think that's where Bank of England's Bailey really is. The vote split expected to be 6-3. So 6 voting for a hold, 3 for a hike. If we see that shifting, and if we see, 5 for a hold, 4 for a hike, then I expect that to lift the pound. But my best opportunity here would be if we start to see a dovish outlook from the Bank of England. Say they start to give any hint of interest rate cuts, then I'd look for pound selling. If you look at the pound on an index level, so just look here at the pound, and you can see that pound's been sort of sold off since the summer, with expectations just ran very high for a hawkish Bank of England. We've got a dovish outlook for the Bank of England. We've seen price pull back to that clear index sort of resistance level and now sold off. So if we see expectations of a rate cut coming in, say we see one person voting for a vote cut, that should be negative for the pound. That's the best opportunity for the pound as well. If they're sort of more hawkish and you see like a 5-4, then I'd expect that to lift the pound around the margins. Short-term scalp, yes, but long-term change, no. And markets are really looking now for expectations of a shift from the Bank of England. ECB decision, again, short-term interest rate markets are getting ahead of themselves. They're seeing like a rate cut in April 2024. If I just check that for us, see that's still the case. See first interest rate cut, seeing 4%, that 3.7%, generally March, April time, right? So that's still the case. And it's unlikely that the ECB embrace that. We've seen slowing Eurozone growth. We've seen slowing inflation. So it's encouraging in an inflationary sense. But the growth concerns are beginning to grow. And so if we see the ECB walking towards a cut, expecting a cut, anticipating a cut, anything even whispering about a cut, then expect from immediate euro downside. So that'll be the best opportunity in its expectations of a cut. And don't forget that we want to see clear signalling that there's going to be a cut in the statement to give us a euro sell bias. Looking at the US retail sales, again, strong retail sales is inflationary, weak retail sales is deflationary. So a very strong print above market's maximum expectations should lift the dollar. Below market's minimum expectations should weaken the dollar. It should be a short-term tradable opportunity. ECB press conference. Don't forget to trade these as essentially two different kind of decisions. You've got the actual rate statement, then you've got the press conference, and then also you get sources reports after the press conference, and then you've got President Lagarde speaking at 3:15. The ECB are a master of this. You get the statement, then you get the press conference, then you get the sources report, then you're getting Lagarde again, then you might get another sources report. So really, what the ECB do, and it's clever, is they drip feed their communication throughout the day, so it means speculators get wrong-footed. So if you move on the statement, then that will be pushed back in the press conference, and be pushed back the other way at the source's point. And then if it's not where the ECB want it to be, then they'll push back in another way with another, either Lagarde will say something or there'll be, another source's piece. So bear that in mind. Cleverly, you can think, okay, well, I can try to take little short-term scalping opportunities throughout that communication. But don't just get caught holding the baby thinking, oh, there's the rate statement, that's it, job done. No, look at the rate statement, then you got to look at the press conference, and you got to look out for sources, and then you got to look out for Lagarde. So it's an itty bitty kind of communication. Obviously, if it's something credible, they really want to communicate a shift, there's an opportunity. And the best shift would be from sort of the perspective of interest rate cuts coming. Friday, to end the week, we got the flash data for Eurozone PMIs and for UK PMIs. Now, this should be a tradable opportunity. Everyone's expecting the Eurozone to slow down, the economy to weaken. So the best opportunity here would be if this is stronger across the board and surprises markets are coming in, with a good, strong number of hand, especially the German data, say the German, manufacturing, services, composite, that all comes in above maximum expectations, and the others are green as well, then that should give the euro a short-term lift. That will be the big surprise, because everyone's expecting, if it's just sort of weak data, that's what everyone expects. Slowing Eurozone, expecting that. So what people won't expect is any recovery. UK PMI prints, again, they're expected to be strong. Look at the expectations, 50.9, 51 for composite and services. That's in expansionary territory. Manufacturing PMI is weak, is across the world really, as that's been struggling post COVID. But if we see now a strong print is actually expected for the UK PMI prints, just in terms of the kind of there's an investment firm, Pantheon Macroeconomics, and they're thinking that this composite is likely to increase further. Right, so they're expecting it to tick up from 50.7 to 50.9. Now for the UK, if the Bank of England sort of say, higher for longer, we need to keep this inflationary battle back, we need to win the battle, we can't give up too soon. But then if that data comes in much weaker than the market's expecting, the market will start studying the pound, thinking, okay, the Bank of England won't be able to keep up this kind of rhetoric. So a big miss here should be an opportunity to short the pound. Obviously, it will depend on what happens with the Bank of England, but assuming the Bank of England sort of keep that higher for longer narrative, which is what I think they will do, and I think central banks around the world will do that this week, with the exception of the Swiss National Bank, I think they, of anyone, have a greater opportunity to potentially cut or signal the end of rate hikes. But the ECB, Bank of England, the Fed should all sort of say, no, higher for longer, we don't want to lose this inflation battle. So if they say that, and then this is a big miss, then the Bank of England may need to cut rates sooner than they're expecting. So I expect a good opportunity for pound selling on this. And I expect that to, run for maybe a couple of sessions. So that's what I'm looking for. Finally, US PMI prints flash for the ending of the week. And again, that should provide a short-term opportunity as well. Same dynamic. Strong data is inflationary, weak data is deflationary. So strong data coming in above market's maximum expectations, right? If it comes in above, 50, 51.3, and this comes in above, the prior 50.7, then I'd look for upside in the dollar. So very, very busy week. Big picture, central banks likely to communicate higher for longer and push back against all the rate cuts that short-term interest rate markets have been pricing in. They've been doing this all year, especially with the Fed. The Fed will cut, it's been wrong each time. So just keep that in mind this week.